Hi everyone, welcome to Dogu's webinar. We are just going to give everyone 3 minutes to join us and then we can get started. But in the meantime, let's just give them that time. Thank you. Hi everyone, welcome back to Dogu's webinar. Welcome, and we can now get started given that we've given everybody a few minutes to join. Just to introduce myself, my name is Radhika Bachu and I am the co-founder and CEO of the business, and I'm super excited to be here. Dogu has been an incredible journey, and my experience very much stems from a very young age wanting to learn how to, make money, which led me to actually study finance and actually go into asset management in London. I'm Kenyan born and raised, and then in 2019 moved back. So my experience, I have over 15 years of experience working and living and breathing finance. And I worked at the largest firms you can think of, Deloitte, BlackRock, the likes. And now in 2019, I moved back to Kenya and decided to set up Ndovu. So I'm really, really excited today to bring to you this topic. It is one of our most common topics requested by a lot of our users. Just bear with me. I'm going to share my slides. Wonderful. So today we're going to talk about how to take your first step towards financial freedom and what type of investments you can actually invest in. So the objective of today, the thing that I want you to most walk away with is how to empower yourself, especially as a first-time investor who's cautious. Actually, 78% of the people who use our platform today are first-time investors. And what I want to give you today is, if there was one thing you would do after this webinar, in order to get started investing, what is that? And the idea behind this is because you're new to investing, it's very important to start slow. So I would always recommend introducing low risk investments such as money market funds, gold funds, and our ETFs. And these beautiful products actually offer you stable returns. And we also give you guidance on how you can get started with small amounts of money, because there's a really big myth that you need lots of money to get started. And you will see in this presentation how getting started with small amounts of money can actually make a big impact on your financial goals. So let's get started. So a bit about Dovu. I think this is important because the one question you should be asking everybody is the company that I'm invested with safe, regulated? Is my money safe? And these are actually very common questions we see with our users. And I'm going to tell you a little bit about our journey so you can understand what we are doing in order to make sure that our company is built with you in mind, and that our every decision internally made is with the fact that we would like to keep our customer deposits safe. So we set off in February 2022. We acquired a license from the Capital Markets Authority to begin with. And as we grew, we actually very quickly hit the threshold, and the fund manager, we were required to upgrade to the fund manager license from Capital Markets Authority. Since then, we actually acquired our license in Rwanda as well as Uganda, which is very exciting for us. And we also launched our very own money market fund. And this journey has been great. We're regulated locally, but we're also regulated globally. So we're regulated by the FINRA, SEC, which are large large regulatory bodies such as the Capital Markets Authority, which is the one you'll most likely be familiar with, that really govern companies like ourselves who are providing these services to make sure we are doing what we say on the tin, and that is investing your money responsibly. And one of our core values at the organization is to have the customer at the mindset of everything we do. And as a result of that, we've been around for two and a bit years, and we're growing. It's very fast. And the number of users we now have on our platform is 71,000 plus. And the average return this year across our portfolios has been anywhere from 13 to 22%, which is really exciting. So let's get into it. The question is around what is a money market fund? And before we get into understanding what a money market fund, sorry, just 1 second. My screen sharing was paused. Technical issues are always happening. So the big question today is like, what are low risk investments? And actually low risk investments are money market funds. So in this scenario, what is a money market fund? Before we can even discuss that, we actually really need to understand the investment landscape. And what do I mean by investment landscape? I just mean what is available for you and I to actually take our hard-earned money and invest it responsibly so that we are making sure it's growing faster than inflation, and also making sure that we're making more money in our sleep. Because let's face it, you and I don't want to go to work every day. We actually want some of our investments to help us meet our monthly expenses. And that's also known as passive income, which is something that if you continue your investment journey with us, we will tell you and teach you and coach you on how to grow your passive income. And doesn't it sound great that your money makes money whilst you're sleeping? But in the meantime, let's talk about the investment landscape and what type of investments there are. A lot of Kenyans, Africans, globally are very familiar with real estate. Real estate is a very strong asset class, and it's a physical asset class. It's something that people can feel and touch, and that's why it has seen a lot of demand. It also is safe because, at the end of the day, you have a physical asset, and it can be income generating if you have a commercial property or a rental property. But one of the biggest challenges that our customers have seen, and speaking to all our customers, is that actually a lot of Kenyans have gone and bought land, and this might be familiar to you, but have gone and bought land, and when it's time for them to actually liquidate or sell the piece of land, firstly, the land has not appreciated, and secondly, so the value hasn't gone up, and secondly, it's really difficult to sell. So real estate is a great investment class, but one of the downsides with it is that it's very illiquid and it's very difficult to sell. The second thing we'll look here is at the bottom, it's bonds. So bonds are typically seen as low risk assets. They're issued by governments or companies. And a bond simply means is that the government, we'll use a government as an example, is here that the Kenyan government will borrow money from you to actually build roads. And they'll say to you that if I, Radhika, give you a million shillings today, I will give you a million shillings for 17 years, and every single year I will give you 12.5% in return. And that is a promise from the government to say, I will give you your money back plus interest every single year. And that's what puts together the regular income. And actually, in the end of the year, in the last year of 18 years now, I will give back what you initially invested and the interest of that year. And the reason bonds are typically seen as low risk is because they're normally offered and issued by companies or governments who are strong, and they are relatively liquid, which is a really good option to have should you need money in an emergency. The second type of investments are mutual funds, exchange traded funds, and I just want to call them funds. So these funds are typically managed by professionals, and they are individuals that know what they're doing with the stock market, the bond market, the commodities market. And what they do is they put together a basket of companies or commodities or bonds and try and generate a return that is outperforms the market, but also is a strong return. And as a result of that, you are able to generate income. These funds are typically very transparent. And also the beauty about them, they're very liquid. And in order to make sure that, the reason I think funds are really powerful is because they're managed by a professional, and you're delegating the job of saying, I don't need to know whether Tesla's share price is going to go up or Amazon is going to expand into Africa. All I care about is, I want to invest in the technology fund as an example, and I want to do it and let a professional manage it. And in order to do that, they charge you a small fee. My biggest advice for anyone who is a first-time investor is to buy a simple fund, because it's low risk, in my opinion, because you're not making decisions as an individual or retail investor. You don't have the time or the skill set to actually make those decisions. So I think funds are a great way to do it. The other share class that I'd like to talk to you about, which you're probably more familiar about, is shares, equities, stocks, and essentially the beauty about equities and shares, this is for individuals who are a little bit more experienced or seasoned investors. But I always recommend, if you're first new to investing, let's create a plan where you first get started by investing in more safer assets, and then we build your education and your knowledge on how to get equities and shares. The beauty about the stock market is that these are managed by you. So you, as an individual, will decide to go buy a Safaricom share, and then you go and look at how is Safaricom doing over a 5-year period? How is Tesla doing over a 5-year period? Do I want to continue holding it? Because you are when you buy a share, you're putting all your eggs in one basket. You're saying, okay, I strongly believe that Nokia is going to be around for 13 to 15 years. And actually, we've seen historically Nokia in the 2000s, when I was growing up, was a very strong company. It is still around, but it's no longer the top 10 companies as it used to be. And so you have to constantly monitor shares, and that's why it makes shares a little bit more risky. There's a really famous saying that says, don't put all your eggs in one basket. And I think that when you invest in shares, you have to be very confident that this company is going to be around for 10 to 15 years. Otherwise, what you're better off doing is just buying a tech fund. And in the tech fund, you're able to get access to Apple, Microsoft, and the likes. And because you're now buying all the technology companies in that particular sector, you're not putting all your eggs in one basket. So what are you doing? You're actually bringing down your risk. Now, in Kenya, we have about 60 companies on the Nairobi Securities Exchange, of which 20 are liquid. I'm not saying don't hold equities or shares directly. In fact, on Dovu, we actually have some fractional shares. But the idea is that you want to put a small proportion of if you're new to investing, you want to put a small proportion of your investment portfolio in there. So these are the types of investments that are available. And I'm just going to give you an update on, what does it mean to hold different types of investments, and why there's a place for different types of investments based on their risk and return profile. So this is a pyramid. You can see that as you are going up towards the top of the pyramid, you are increasing your risk, but you're also increasing your potential for higher return. And on this side, as you go down the pyramid, you're actually reducing you're reducing your risk, but you're increasing the safety of your principal. Now, from all the 71,000 customers we have on the platform, we actually know that majority of Kenyans are very focused on protecting the capital and making an additional return. but not having significant volatility. So somebody who is in our world who is looking to protect their capital and looking for a little bit of growth is known as a balanced investor. And an aggressive or adventurous investor is somebody who's willing to take the market ups and downs, but would like higher returns. So in this pyramid, I'll just take a few minutes to sort of explain. At the bottom of the pyramid, you can invest in checkings and savings accounts. You can invest in treasury bills, bonds, and they're typically seen as low risk. But the reality is that you're not going to outpace inflation. In a savings account, the max you're getting in Kenya, if you have small amounts of money, is actually 4%, 4 to 5%, and inflation in Kenya is actually 7%. So that means the purchasing power you have every day is actually eroding because your money is sitting there and doing nothing. Now, treasury bills are really, really interesting, but they're also difficult to come in and out of. But they're known as low risk. The other type of bonds, the second level of risk in terms of investments are things such as municipal bonds, money market funds, and corporate bonds. So actually, these become more interesting to hold. Even in Kenya, we have so many strong low risk money market funds, as well as corporate bonds and government bonds that actually make sense to hold them. So they're typically seen as low risk. The next period is the medium risk, balanced risk. So this is mutual funds and exchange traded funds, all funds that we will talk about shortly. And again, the reason they're medium risk is because you are buying a basket of bonds or a basket of equities, a basket of cash-like instruments. And actually, when you buy a basket, you're actually spreading your risk across different eggs. And so you're not putting all your eggs in one basket. And then, of course, as you move towards the top of the pyramid, you can see that we have shares and crypto and hedge funds, which obviously the risk is super high. So the likelihood of you losing your capital is high, but actually on the plus side, your returns are going to be super high as well. As a first-time investor, I would recommend holding a money market fund and exchange-traded funds, especially both local and global. And I'm going to talk to you a little bit about that shortly. So here we are. So what is a money market fund? So a money market fund is something that you are all familiar with. I know we hear and see billboards in Kenya about mutual funds, etc. So you are very familiar with, an auntie or an uncle has talked about it at a party. And essentially, it is a cash fund, and it invests in short-term, high-quality financial instruments like treasury bills, commercial papers, and deposits. And the beauty about a money market fund is that it's managed by a professional. So you don't have to physically go and seek out treasury bills, commercial paper, or set up a deposit with a bank. It actually, a professional person like ourselves, we have a portfolio manager who will go in and manage that portfolio for you. The beauty about a money market fund is that even though the returns are modest, they're typically better than traditional savings accounts. And actually, our money market fund returns higher than inflation, which is great because that means you're actually growing your money. And it's typically seen as low risk, and you can liquidate your assets whenever you like. And there are some money market funds across the market that you can fix your money in order to get a slightly higher return. And I think that's also a really good option to look at. And the key thing that you want to take away about a money market fund, which is simply a cash fund, is to say they offer better returns than holding your money in savings accounts that are offered by commercial banks. And so introducing Dobu's money market fund. So we have launched our own money market fund, and the return that it's targeting is 15.5% per annum, and this is after fees. So it's very exciting. Again, what it's doing, it is investing in cash-like instruments that are steady, guaranteed. You're going to get something over an 18-month period, and the fund return does change. And the beauty about the Dobu Money Market Fund is that you can get started with relatively low amounts of money. I always say get started with 10 to 15,000 shillings. The minimum for this fund is 500 shillings. And the idea is that when you get started and you start experiencing how the fund works, that's when you really get value. So you can learn all these amazing things and listen to webinars and podcasts, but until you don't actually make your first investment, it's really difficult to understand the market. So for first-time investors tuned in today, I would recommend starting with a small amount of money and start looking at the Dobu Money Market Fund, because a 15.5% return is way better than money. sitting in a bank. And that leads me nicely on to why. So why is holding your money in a money market fund better than holding it in a bank? So let's do a quick example. So the first table shows here what you would be earning if you had held your money in the Dover Money Market Fund, and what it would do if you compared to holding that money in a bank. So we've taken the average return of a bank to be about 3%. It varies from banks to bank, but we've taken an average of 3%. And then we've taken an average of 15%, which is what the Dover Fund is generating. So let's say that my name is Sharon, and I started investing in the Dover Fund, 15,000 shillings every single month for 5 years, versus what I would have held in a bank account. So if you look here, if I had invested my money 5 years ago, every single month, 15,000 shillings, my money today would be 1.4 million shillings. And if I compare it to what it is in the bank, it actually is less than 1 million shillings. So if you just come down here and look at this table here, and so that means you're leaving about 500,000 shillings on the table because you're not making the right financial decision for yourself. Now, just imagine what 500,000 shillings could do for somebody like yourself. I know it definitely changed my life. And to be honest, it means I can send my kids to maybe a slightly better school. And I think it could make a huge difference for somebody who wants to study further, go on holiday. And it's just about making that smart decision of saying, actually, instead of holding my money in a bank, what should I do? What would I do? Now, for ease, I've actually highlighted what it would look like if I had put in 100,000 shillings every single month for a 5-year period. That would amount to 9 million shillings, which is very exciting. But if you look at what it would amount to if you held it in a bank account, it would amount to 6.5 million shillings. That means now you're leaving 2.5 million shillings on the table. To be honest, when I see these numbers, and I'm a numbers person, but just looking at the difference of actually, if I saved 100,000 shillings every single month for 5 years, the difference of holding it in a bank account versus Dover Money Market Fund is 2.5 million shillings. It really makes me think that this is a no-brainer. And that's the beauty about investing. Investing is for the long term. You have to be patient. It's not magic, and you need to do it responsibly, which I'm very, very passionate about. It's actually one of our core values at Dovu. We help you invest responsibly, because the reality is that investing, like anything else, is built with better, strong behaviors where you come back and invest every single month, and also invest regularly, but do it responsibly. So how would I, if I was a first-time investor, how would I integrate the money market fund into your investment strategy? So the first beautiful thing about your portfolio, when you're thinking about creating a personal portfolio for yourself, the thing that you want to make sure is that, again, you don't want to put all your eggs in one basket. So you want to do the following things. You want to preserve your capital. You want to grow your money while you're sleeping, and you want to do that smartly by diversifying your assets. So this is some investment terms that you think about. So capital preservation, protecting what you have, growth, taking responsible risk in order to achieve your growth, and then diversifying that because it's very important. So the first thing I would do is, as a new-time investor, I would think about building an emergency fund. An emergency fund simply means that should anything happen, someone falls sick, your car breaks down, you don't have to draw from your growth portfolio just to meet those needs. You actually have some money in the bank that you can withdraw. And the way that I would build the emergency fund is twofold. So so as an individual, you're earning a salary every single month. Of that salary, the standard for you to be saving is 25%. 20% is great, but 25 is at the top. And you obviously just don't want to save it, you want to invest it. So let's just say that I'm earning 100 million shillings, and I am saving 25% of that. So I'm saving 2.5 million shillings every single month. But again, I don't want to put the 2.5 million shillings into Safaricom stock. I don't want to put the 2.5 million shillings in a money market fund either, because when you create an investment portfolio, it's all about being balanced. And so what I would do is that when I create an emergency fund means that you can manage 3 months of your basic expenses. So these are your food, rent, shelter, transport, getting to work, should anything happen to you. And In that time, hopefully you'll be able to get another job, etc. But you've got 3 to 6 months of runway in a money market fund. And the way that I would split that 3 months of runway is to hold 20% in the Dover money market fund and 10% in your bank. So the reason I would put 10% of my liquid cash in a bank is that it's easily accessible. So if there's an emergency and you need the money now, you are actually able to take it out immediately. Whereas with the money market fund, it takes on average 3 working days in order to get your money back, which is industry standard. And this is why I would split the allocation as that. Now, I'm making 2.5 million shillings. This is great. I'm sorry, I'm saving 2.5 million shillings. This is great. I mean, that's a really high example, but it just came to me. And I now have put 30% of that towards my emergency fund, which I think is a great allocation. But actually now I need to grow my portfolio. I want my money to grow so I can quit my job and go travel, or quit my job and enjoy time with my kids, as an example. So the goal of your growth portfolio is that you want to make sure your money is growing while you sleep. Now, when you hold your money in a bank account, it's not growing, it's losing value as we speak. And as a financial advisor, it's one of my biggest pet peeves to hear someone say that, oh my God, I've got my money in my bank. It's always a little worrying. The second thing, and the success that I've seen in being in finance for over 15 years, is that keep your investment journey simple. Like, keep the investment strategy simple. You will hear all these crazy financial terms. You'll hear all these stories of people trying these interesting, cool ventures. Actually, if you keep it simple, it's the best way to grow. And the reason I say that is because there's a lot of data that shows, if you go back 100 years, and you take an investor who did the crazy investments such as crypto, hedge funds, and you'll remember the pyramid now, individual stocks, and you take an investor who simply bought the S&P 500, which is just a fund. The person who bought the passive S&P 500 over a 100-year period actually outperformed than the person who took a lot of risk. Because what happens is when you take a lot of risk, there's a lot of losers, and actually your returns average out. Whereas if you just invest in the market and let human innovation, human progress do its work, then the market will continue growing and you actually benefit from the returns. And the most important thing about your growth portfolio, given that we live in Kenya, we're global citizens, we live in Kenya, but we all have iPhones, we all have Samsungs, we all have laptops, we all like to travel. I like how I'm putting all, but majority of us like to do those things. You need to be able to hold some of your investments in USD, because over the last five-year period, our Kenya shilling has weakened by 22%. So it's very important for you to hold 50% of your wealth in Kenya shillings and 50% of your wealth in USD. And as I mentioned earlier, in your capital preservation portfolio, you're already holding 30% in Kenya shillings because you're doing the money market fund and you're doing bank savings. And now is the opportunity in your growth portfolio to actually invest in global funds. But global fund sounds risky, but today I'm here to show you how we can do that responsibly. And then lastly, of course, we want to add diversification. Diversification meaning you don't have all your eggs in one basket. You want to have all your investments in different things. So we already achieved diversification because we're saying we're going to hold some money in a bank, we're going to hold some money in a money market fund, and then we're going to hold some money in global index funds. And those are all different things, and they all perform differently when markets are moving. So again, we've naturally and organically achieved diversification. So I talk about the Dover Money Market Fund, which gives you on average 15.5% a year. That's incredible, but that's only your Kenya shilling allocation. Now, for the first-time investors who I would like you to get into the market with, a low-risk type product, so that you start becoming very familiar with the markets and how it works. The next fund that I would introduce to you is the gold fund. And the reason gold is really important part of achieving diversification and your portfolio is that, let's say I had 20,000 shillings today, I would put 10,000 shillings into the money market fund, and I would put 10,000 shillings into the gold fund. And the reason being is because on this chart here, this is how gold has behaved since 2014. And this blue line is how the global markets have performed going forward. So you can see that like I mentioned earlier, investing is for the long term. You have to be patient. The seventh wonder of the world is compounding interest, and compounding interest only really comes to life when you are in the market for long enough. And this is a 10-year projection of how gold has performed over a 10-year period in comparison to how the stock market has performed, which is the S&P 500. So for those of you who don't know what S&P 500 is, the S&P 500 is the 500 most valuable companies in the US, and they are simply put into a fund, so a simple fund, and the market does its wonders. We don't have to worry about it. These professionals will go out and manage that for us. And essentially, this is how the blue line has performed. So the one thing you should take away from this is actually the market has always gone to the top right. So you're always growing value. So if you were new to investing and you wanted to start investing, I would invest in the blue chip fund, in addition to the gold fund and the money market fund, because actually it is constantly going upwards into the right direction. But this is how gold has done in relation to the S&P 500. So the reason gold is steady is you can see in 21, everyone's familiar with COVID, everyone was impacted by it. When the stock market came down, gold continued to rise and steadily rise over a long period of time. And that's the beauty of gold. This is why it's a great diversification tool in your investment portfolio, because the reality of it is that when markets go up and down, gold consistently continues to grow because everybody in the market rushes to gold when they feel that the global market is at not growing and things are at a recession. So again, the reason this is important, and going back to your portfolio construction, is because we've now allocated some money to your Kenya shilling portfolio in a bank account and the Dovu Money Market Fund. And now you're actually investing in low risk assets with gold, but it's held in USD. And so the way it works on the platform is that if you have Kenya shillings and you want to invest in the gold fund, you take 15,000 shillings and invest it into the USD fund. Dovu will then go away and convert that Kenya shillings into USD and invest it for you. And so you then start earning returns on US dollars. So this is a really powerful very powerful chart, because it shows you how gold has consistently performed, but it also gives me a nice segue to talk to you about after you have invested and built your low capital preservation, low risk capital preservation portfolio, what would you do next? And the next progression would be to actually look at investing responsibly in smart options. Now, on Dovu, this is just an introduction to what there is. I would highly recommend setting up a call with one of our team members, our relationship managers, and they'll talk you through everything. But one of the really exciting things you can see here is, for example, last year, from 1st January to December 31st, 2023, if I had invested 100,000 shillings in the technology fund, and the reason why this is called as smart investing is because as a retail investor, you don't know anything about investments. And the one thing that you're very sure about is that technology in 10 to 20 to 15 years, 10 to 15 to 20 to 25 years will continue to grow. Why? Because we're at the tech forefront. AI has just been brought in, and there's yet so much progress that the technology sector is yet to see. And it's already proving that. So if you had held the technology fund, the techie fund, from 1st of January to December 2023, your 100,000 shillings would have grown by 52%. So that's for those business entrepreneurs on the call, that is actually 1.5x in your business. You're growing your business by 1.5%, which is incredible. And we have lots of other funds. And the beauty about the value that Dovu provides is that in the investment universe, we have over 7,000 funds. And instead of confusing our users as to which fund they should pick within the technology sector, our investment committee spends a lot of time looking at the funds available and actually saying, okay, out of the 25 funds available in the technology sector, this is the best fund to hold. And we review this on an ongoing basis. We make sure that our customers' money is always safe at all times. And as a result of that, you can see, and I shared this earlier, that this year, because markets go up and down every year, our average return on our platform has been anywhere from 13% to 22% on the dollar, and we're very proud of that. Which investment in Kenya today is giving you 22% on the dollar? So it's really, it's really makes us really happy to see that we're doing such great work. So why Dovu? So the reason I think investing with us is important is because, first of all, we help you build a balanced portfolio. We give you options for your capital growth preservation. We give you options for your growth portfolios. And we also give you access to local government bonds, etc. And it's a one-stop shop where we allow you to build a portfolio and see it transparently on an app, which I think is really important because you should know how your money is performing daily. Secondly, the most important thing is, the real question you should be asking investment managers when you speak to them is, how do you keep my money safe? Of course, the first sign of safety is regulation. We're regulated by the SEC in the States, which is a global regulator, which is highly valued. Capital Markets Authority, Kenya, Rwanda, Uganda, ICFA, and FINRA as well. So whatever. So our company has been built on strong foundations, which is really important. And also the last thing is that we empower you to invest responsibly. So we do that by making sure that you are taking the right amount of risk in your portfolio. We give you balanced options of how to take medium risk and low risk in order to achieve your financial goals. We're fully transparent. You can see everything on your phone. You have easy access. So should you need or be in the need of an emergency, it takes 3 working days to get your money back. And then also, if you needed some financial advice, we have some advisors who are able to help you really navigate your portfolio. And I think that really is the value that we can bring. We handhold you, we guide you, and really we're here to help you grow your money responsibly. So the 3 key takeaways, I find webinars can be quite long, so I like to keep things a little short. So the key 3 takeaways I'd like to say is that you are doing yourself a disjustice by holding money in a bank. Like, that is the worst thing that anyone can do. I definitely know the rich definitely don't hold their money in a bank because they've just been educated on the fact that if you hold money in your bank, you're losing value than just making a simple, smart decision by investing in a money market fund. And I would recommend investing in the Dovu Money Market Fund because we have designed this with a lot of care. And the last thing is that if you the next progression of your investment portfolio is to actually hold some USD because we do see a lot of currency fluctuations, and actually we're global citizens. So if we're purchasing in USD, we should also be earning in USD in some shape or form. And the best way to do that for a first-time investor or somebody who's a little bit shy when it comes to investing is to simply hold a gold fund. The gold fund has performed significantly well over the last 3 years. And is generating a steady, constant return, as you saw earlier. So my advice is to first start off with this, and then we are here for you to help you then build and look at other safe investment options as the S&P 500, the technology fund, etc. And I think you could get started with those today. It's not that, but really this was targeted. This webinar talks about low risk investments, and to be honest, the S&P 500. In my eyes, is low risk because we help you do it through a fund and not buying individual stocks. So yeah, so that brings us to the end of our session today. But what I would like to do is I would like everybody to spend a couple of minutes and just download the app. I think the first most important thing is for you to download the app, register, and start having a look at what's available. The app is very interactive. It's intuitive. You can see how some funds have performed over time. Play around with it and reach out to us should you have any questions. And so I would say, let's do that now. And what I would recommend is that if you have any questions, etc., that you just put it into the chat and I can read them and answer them to you, or we can respond to you via chat. I hope you found this webinar useful. Just remember, the best time to plant a tree was yesterday. And it's the same concept with investing. Whether you have a lot of money, a little money, the idea is that you must get started today, because let's face it, the cost of living is going up, things are becoming more expensive, but our salaries, our income are not increasing at the same pace. So what can you do, and what could you do for yourself? It's actually doing smart, responsible investing. And we really are here to help you with that. So yeah, thank you so much. And thank you for your time. I look forward to seeing you on the platform. Thank you.